This conference will now be recorded.
Hello and welcome. My name is Yasir Gulfraz. I'm your tutor for UK taxation for business. Today we will discuss or we will start with our learning outcomes 3. So recap is PPCIO, professional behavior, professional competency and due care, CPD, competency and capability, confidentially, integrity, objectivity, parent, subsidiary, associate, simple. Indicative content, range of different type of investment and other expenditures that may result in reduction in tax liabilities for individuals and both incorporated and unincorporated businesses organizations. Be able to advise on the appropriateness of each of these types, understanding of legitimate tax planning, mitigation of tax based on numerical analysis and recent argument assessment of ethical and professional issues, current issues in taxation. So there are several type of investments and expenditures that can help individuals and businesses reduce their tax liabilities. These include things like investing in tax efficient vehicles, like ISA or pensions, claiming allowable expenses, making charitable donations or investments in certain type of businesses or in the industries that qualify for tax relief. Legitimate tax planning involves using legal methods to reduce tax liabilities. Mitigation of tax involves using a variety of numerical analysis and reasoned arguments to minimize tax liabilities. This can involve careful planning of income, expenses, and investments to ensure that tax is minimized as much as possible, uh, while still remaining within legal boundaries. Can you hear me properly? Or can you see my screen? Hi, Nizar, you okay? Hello? Hello? Can you hear me, Nizar?
Can you hear me now?
Yeah, I can hear you. Can you
Oh
hear
yeah,
me?
sorry, I was on mute. How are you?
Yeah, fine. How are you?
Not bad. Sorry, I was a
I
bit
just,
late.
no, that's fine. I just started now, you know that. I'm just
Yeah.
here, page, if you come to the page 3.
Okay. Perfect.
Oh, yeah, there are a range of different types of investment. Can you see my screen and can you
I
hear
can.
me?
Yes. Yeah, I can
Okay.
hear you. I can see this.
If
Yeah.
there's any issue, just, let me know.
Yeah. No worries. Okay.
A range of different types of investments and other expenditures that may result in reduction in tax liabilities. Basically, here there are is talking about various types of investment and expenditures that can help individuals and businesses reduce their tax liabilities.
Mhm.
So these including things like investment in tax efficient vehicles like ISA or pensions claiming allowable expenses.
Mhm.
Uh, Legitimate tax planning involves using legal method to reduce tax liabilities. And mitigation of tax involves using a variety of numerical analysis and reasoned arguments to minimize tax liabilities.
Mhm.
Next, he's just talking about again, repeating same things we have discussed yesterday. You know that basic rates, higher rate, additional rates, saving rates. So 20% and dividend rates, 70.7.5%. Uh, Dividend nil rate band starting rate of 0% applies to saving income where it falls within the first 5,000 of taxable incomes.
Mm-hmm.
So again, is the same we discussed yesterday. Personal allowance, UK residency, previously residents, non-previously resident. It's the same chart we discussed yesterday, if you remember that. Okay.
Yeah.
Then again, car benefit allowance, relevant basic pension scheme limits. Yeah, evaluate type of investment and expenditures resulting in a reduction in tax liabilities. So basically, when conducting an investment, appraisal for a company, it is important to consider the impact of corporation tax. So most companies are subject to corporation tax, which is charged on their profits. So this means that the amount of tax that a company is liable to pay needs to be taken into account. So when assessing the potential returns of an investment. So, tax charge on company's profit is a relevant cash flow for the purpose of calculating net present value. So this means that any additional income earned by the company will be subject to additional tax. So, impact of corporation tax, tax relief in investment spending, or tax charged on operating allows. Corporation tax charged on a company's profit is a relevant, net present value. Uh, Net present value purpose. Overall, when conducting an investment appraisal, it is important to consider both the tax liabilities and the tax relief. Okay, opportunities associated with the potential investment in order to accurately assess its potential returns. Impact of taxation on the discount rate. When calculating the VACC, weighted average cost of capital, and the cost of debt should always be a post-tax figure. For example, has been adjusted for the tax relief on interest. This is the normal way of determining the VACC, so no extra work is required. The adjustment takes into account the fact that interest payments on debts are tax deductible. So the cost of debt is effectively reduced by the tax relief. Taxations can have a significant impact on cash flows and investment appraisal. Project cash flows will give rise to taxation, so which itself has a impact on project appraisal. Organization can benefit from claiming capital allowance, which are a tax deductible alternative to depreciation. So the effect of these allowances is to reduce the amount of uh, tax that the organization is required to pay, so which can have a positive impact on cash flow and investment returns. Yeah, any question,
No,
Nizar?
no.
Okay. So here, overall, it is overall it is important to consider the impact of taxation on cash flows and investment appraisal when assessing the potential return of an investment. So this involves taking into account factors such as the tax relief on interest, the availability of capital allowance, and the effects of tax on profit cash flow. So here we'll talk about capital allowances. So capital allowances, or WDA, that allowance for tax purpose, a business may not deduct the cost of an asset from its profit as depreciation. So for tax purpose, business cannot deduct the cost of assets from the profit as depreciation in the way that they do for financial accounting. purpose. Instead, the cost must be deducted from taxable profit in the form of capital allowance. So the basic rules of calculating capital allowance uh, are here. He's talking about different ways to calculating capital allowance. So for example, WDA are calculated based on the written down value of the assets, which will be on either a reducing balance or straight line balance. These are depreciation method if you have ever heard, during your ACC, or might be if you work for assets. So depending on the method specified in the question, so total WDA given over the life of an asset should equate to it falls in value over the period, which is calculated as the cost of the assets less any scrap proceed. WDA should be claimed as early as possible to maximize their tax benefit. So WDA's capital allowances should be given for every year for of ownership, except the year of disposal. When I hope you know about disposal of assets.
Yeah.
So overall, capital allowance or WDAs provide businesses with way to deduct the cost of assets from their taxable profit over time, rather than all at once. By understanding the rules of calculating capital allowances, businesses can maximize their tax benefit and manage their cash flows more effectively. So, original cost of assets, cumulative capital allowance claimed, written down value of assets, disposal value of the assets, balancing allowance or balancing charge. So when calculating capital allowance for tax purpose, there are few key terms of understand. Or original cost of the assets. Original cost of the assets. This refers to the total cost of purchasing the assets. So including any additional cost such as installation or delivery cost. So cumulative capital allowance claimed. This refers to the total amount of capital allowance claimed for the assets over the lifetime. Okay.
Hmm.
So a written down value of the assets. This refers to the remaining value of the assets after deducting the cumulative capital allowance claims from the original cost of the assets. So disposable value of the assets, this refers to the amount of money received from, selling or scrapping the assets.
Hmm.
So balancing allowance or balancing charge in the year of sale of or disposable. A balance allowance or balancing charge is calculated to adjust for any difference between the disposable value of the asset and its written down value of the assets. uh, Assets of assumed to be brought at. He's giving an example that when we buy the assets, cost of assets, this could be very end of an accounting period, 31st December 2001 or whatever, or the start of another. There's no distinction between these dates for discounting, but there is for tax. Asset brought on the start of accounting period. So next is lying out of net present value questions. So when evaluating investment, for majority of investment appraisals questions in exams, the following pro forms in recommended. So net trading revenue, tax payable, investment, residential scrap, residual scrap value, tax relief, working capital flows. So net trading value, the value, the inflow and outflow of funds and trading, such as sales minus operating uh, cash flow, if necessary, adjust for inflation, calculate as usual based on the money flows multiplied by the tax rate. So tax payable ty- typically, that deferred by 1 year. So investment next is should need inflating. So tax relief on written down allowance, and then capital working allowance calculate using monetary figure. Oh, sorry, money figures. So here, pensions and his chat talking about pensions and other tax efficient investment products like pensions, enterprise investment schemes, different kind of schemes, seed investments, schemes, venture capital trust, scheme tax relief, contributing to a pension scheme, receiving benefit from a pension scheme, end of their services or job. Type of trading loss relief. So here he is showing some kind of trading reliefs against total profit, against figure total profit, current AP carryback, that 12 months current. So basically, loss relief against total, profit before here is a qualified charitable donations. So this type of relief allows a business to offset trading losses against all profit, excluding QCDs in the same accounting period. So carry back against profit of the preceding 12 months. So this type of relief uh, allows a business to offset trading losses against profit made in the previous accounting period. So up to a maximum of 12 months prior to the loss making period. So loss relief against the future total products here, law against future total profits. So this type of relief allows a business to carry forward trading losses to offset against future profits. So with no time limit on how long losses can be carried forward. Can you hear me, Nizar?
Yes, yes.
Okay, okay, okay. So next is a relief against total profit before profit, QCDs. So charitable donations. So claim against total profit before QCDs must claim against current AP first before claim against previous 12 month. So there are two type of trading here. Yeah, claim trading. There are two type of trading loss and relief availables. Uh, the first as a claim against total profit before QCDs, which must be claimed against the current AP before claiming against the previous 12 months. So it is important, that claims are optional and partial claims are not possible. So, for example, he has his total profit before, donations are 56,000 pound of loss to offset the profit, leaving only 4,000 pound of loss remaining. So if there are no profit remaining from which of deduct QCDs, they become surplus and there is no relief available of them. So if there are no profit left for which to deduct from QCDs, that means the QCDs become surplus and there is no relief for them. So for example, they are wasted.
Hmm.
So, yeah, next is carry forward relief. Trading losses are automatically carry forward. So, our trading losses are not claimed in the current year or carried back, are automatically carry forward. So, how the trading losses are treated depends on whether they arose before or after 1st April 2017, pre 1st April 2017, trading losses are automatically carried forward against the first available future trading profits from the same trade and cannot be used against any other profits. So, post 1st April 2017, trading losses can be claimed to offset against total profit, and the taxpayer can uh, choose how much to offset and how much to carry forward to future periods. So, however, the losses can only be carried forward in the trade has continued and has not become small or negligible. So here is a calculating corporation tax loss pro forma. So trading income, other income, net chargeable gains, total profits, less relief current year, carry back, carry forward. So less uh, donations, or total taxable profit. So this pro forma for calculated corporation loss, so with column of for the year, for the years ending on December 31st on 2019 and 21. The table includes figures for trading income, other income, net chargeable gains, and total profits. So the loss column indicate here the loss column indicate uh, the amount of loss incurred in each year, and there are a separate column for loss relief, including current year, carry back, and carry forward relief. The table also shows the amount, qualifying charitable donation here, and any loss wasted or carried forward. So the total taxable profit column indicate the final taxable profit after taking into account any loss relief. Uh, Next, uh, the year ending, above is still talking about above forma. The year ending 31st December 20 is the loss making year. So in this pro forma has loss of 2020 is the set off against total profit before qualifying donations of current AP, total profit before donations of previous 12 months. So the loss of the year ending 31st December 2020 is used to offset against total profit before QCDs of the current accounting period and the previous 12 months. So the remaining loss can be carried forward against total profit, so which can be restricted to avoid a wastage of donations, charitable donations. It is important, that before setting off the loss against the. Can you hear me?
Yes, yes, I can.
Okay, okay, okay. 12 months, a current accounting period claim must be made first. Alternatively, the loss can be offset against the total profit before qualifying charitable donations of the current accounting period, or all of the loss can be carried forward against future total profit. So next is short previous accounting period losses can be carried back 12 months. So even if a company experiences a loss in a short previous accounting period, the loss can still be carried back for 12 months. So the loss can only be deducted from a proportion of the profit of the for the period preceding the since the previous accounting period in shorter than 12 months. So for example, if a company has a loss in the 12 months uh, on 31st December 2020, and the previous accounting periods were for the 8 months to 31st December 2019, and the 12 months to 30th of April 2019, the loss can be carried back against all of the total profits for the 8 months to 31st December 2019 and uh, 4th of December of the total profit of the year ending 30th of April 2019. Next, factors to be considered when choosing loss relief. Two main considerations. Does the company want earliest reliefs as soon as possible? So uh, there are two main factors to consider when deciding on loss relief options for a company. So first, does the company want to obtain relief as soon as possible? So if yes, then a current and carryback claims would be preferable. Secondly, does the company want to maximize the tax relief? So in this case, UK corporation tax rates are decreasing, so a current and carryback claim would still is the best option. So here is a capital losses automatically relieved against current period chargeable, excess loss, no carryback relief available. So when company incurs capital losses, these losses are automatically offset against any current period chargeable gains. Any excess capital loss can be carried forward and used to offset gains in future periods. So, but carryback relief is not available for capital losses. Capital losses can only be used to offset chargeable gains and cannot be set off against income. So we discussed yesterday, if you remember, research and development tax credits as well. So small and applies to small and medium-sized enterprises. So small and medium-sized enterprises can benefit from a tax deductions of additional 130% of qualifying expenditures for tax purpose, uh, for research and development purpose. So this means that for every £100 spent on a research and development, the SME can claim and allow able tax deductions of the original £100 plus further £130, not plus £30 plus £130. So resulting in a total tax relief of £230 of the initial £100 expenditures. So in deduction creates a loss, it may be surrendered for a cash payment for HMRC. So it may be surrendered to HMRC in return for a cash payment. So the cash payment is calculated at a rate of 14.5% of surrendered amount. If the loss is surrendered for a cash payment, it cannot also be carried forward. So to qualify for a research and development tax relief, the expenditures must be revenue expenditures and incurred on a project that seeks to achieve an advance in science or technology that is relevant to the company's trade. Next is talking about IR35, which is personal services companies. So IR35 is here is talking about anti-avoidance legislation, often called IR35, after the press release announcing the legislation. So IR35 is an anti-avoidance legislation that was named after the press release announcing the legislation. So personal service company is typically a company with a single shareholder who use the company to provide services to clients. So the legislations come into play when the uh, personal services companies uh, is used to conceal an employment relationship. So the owner of the PSC can avoid paying tax, particularly NIC, national insurance, by taking money out of the company in individuals rather than in the form of salary. So uh, here relevant engagements, the legislations only applies to relevant engagements. For example, a contract between the company and the client, which would have been a contract of employment in the absence of PSC. So if IR35 applies, uh, the client company is not effective. The PSC has to treat this income from relevant engagement arising in a tax year as if it were paid out as salary to the employer. Can you hear me, Nizar? Hello?
Yeah, yeah. Sorry, yeah, I can hear you.
Oh, okay, okay.
I'm following you.
The anti, yeah, yeah, that's fine. Anti-avoidance legislation, known as IR 35, only applies to the personal services company and not the client company. So the personal services company, which is usually owned by a single shareholder, uh, which must treat income from relevant engagement. So as if it were paid out as salary to the worker, and account for income tax and national insurance contribution on the national salary, deductions are only allowed for actual salary paid. So expenses typically allowed to employees and a flat rate 5% deduction. So sign of a relevant engagement include the inability of the workers to send substitute the previous provisions of tools and equipment by the client company, dictating the hours of work, and the PSC having only one or two clients. Any questions so far, Rizal? Is that all right? Everything
Yeah, everything's fine.
okay?
No question.
So next is evaluating the mitigation of tax for individuals and businesses. So here is talking about mitigation of tax for individuals and businesses. So tax planning, as a tax planning advisor, or as an accounting, you have a significant responsibility to provide legally sound advice to your client, while abiding by the principle of professional competence and due care. So it is essential to, distinguish between legal tax mitigation, which is tax avoidance, and illegal behavior such as failing uh, to disclose information, to providing false informations, which is tax evasion. So just bear in your mind, I hopefully you already knows that tax evasion is illegal, activities, but tax avoidance, which is legal tax mitigation. Okay. So uh, tax evasion, the evasion or attempted. Uh, have you come across with any kind of tax evasion? Hello?
Tax evasion. Um, sorry, can you hear me?
Yes, tax evasion.
Sorry, the question was.
Yeah, yeah, I can hear you. I can hear you. Any idea about tax evasion? Have you seen any client like is asking you for a tax evasion?
Um, I mean, the normal question is, how can I reduce my tax? Not, how can I not pay the amount? Stuff like that. So, yeah, so that's the main question. So I get.
Yeah. So basically, tax evasion is, as I explained, that it's illegal activities. Tax evasion
Yeah.
is an illegal activity. Attempting to do so, against it goes against the fundamental principle of integrity and professional behavior. So it is also a potential criminal offense under tax law and money laundering legislation. So
Yeah.
it comes under money laundering legislations as well. You know that.
Hmm.
So, but I think so in UK many people try to do that, but it is a criminal offense as well.
What,
Okay,
trying to avoid paying
so
tax?
but yeah, yeah, they don't use basically legal ways, uh, but they try to they don't use avoidance scheme. Instead, they try to use evasion, tax evasions ways.
Yeah,
But as a professional, you have certain responsibility when working with clients.
of course.
So
Yeah.
he discussed here, that as an accountant or financial advisors, if a client fails to provide information that you have requested, such as for tax returns or computations, you must assess whether it is appropriate to continue acting for them. So you should advise client to make full disclosure to HM revenue and customs, or to authorize you to do so if errors exist. So, if any errors have been made in previously submitted information, if the client refuses, you must cease acting for them. You shouldn't act for them, shouldn't work for them. So you should inform, even you must inform HMRC that you are no longer representing the client,
The cloud.
but you are
Yeah.
not obligated to explain why, as it would violate confidentially.
Hmm.
But many people do, but might be many don't. So direct tax avoidance scheme promotes of tax avoiding scheme related to direct taxes, such as income tax, national insurance contributions, capital gain taxes, corporation tax, inheritance tax, and stamp taxes, must legally disclose the details of their schemes. Taxpayers may also be required, to disclose such information depending on the circumstances. Failing to comply with these disclosure provisions can lead to penalties, which is up to £5,000. So, if the failure continues after the penalty has been imposed, further penalties of up to £600 for £600 per day. So, businesses using VAT avoidance scheme must also notify, uh, must that businesses also notify HMRC of their use. So, with the penalty for failing to do so being 15% of the VAT saving resulting from use of the scheme. So the penalty for using other arrangement uh, is £5,000.
Hmm.
So I don't know, have you ever, seen things like that, or you know?
No, not yet. Well, hopefully I won't.
So you work under the legal, limitations,
Yeah. Yeah.
which is, uh, are you registered with HMRC as an accountant, or based on your
Well,
ACCA qualification? Is that right?
for the well, I mean, I the doing the anti money laundering kind of check with HMRC.
Okay, yeah, yeah,
So that's basically
yeah,
what
yeah,
registered for. Not as an agent, so I don't represent many as an agent.
yeah. You can do after, I think so, IFA
Exactly. Yeah.
license.
Yeah.
Yeah, you can do some more. Yeah, yeah. So next is serial tax avoidance. Serial may HMRC may classify tax payer as a tax serial tax avoiders if they use multiple scheme which have been defeated after 6 April 2017. Defeat of a scheme occurs when an agreement is reached with the HMRC so that the expected tax advantage of the scheme does not apply, or HMRC has a favorable ruling. regarding the assessing of the scheme. So, if a taxpayer is classified as a serial tax avoider, they will receive a warning notice for 5 years, which can
Sorry.
you hear me now? Yeah, okay.
Yeah, 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 okay.
Sorry. Yeah. So 5 year, which requires them to submit additional information about their tax affairs to HMRC every year. So such as the use of tax avoidance schemes, sanctions against serial tax avoiders may include penalties for entering into further scheme during the warning notice period. So public naming as a serial tax avoider, the restrictions on direct taxes reliefs up to 3 years. Next is evaluate ethical and professional issues arising from the giving of tax planning advice. So here's ethics, ethics, tax avoidance schemes, ethics, tax avoidance scheme. So, obviously, you know that ethics, moral principle, and values that guidance behavior in the tax profession. Okay,
Mhm.
so including integrity, objectivity, confidentiality, and any the professional competencies. So, tax avoidance schemes arrangement designed to minimize tax liability. That often through exploiting loopholes in tax laws. So there are in ethics, when we talk about ethics, there are fundamental principles, uh, underlying principle that govern the behavior of tax professionals, uh, prospective clients, individuals, or companies that are considered hiring a tax professional for their services. Uh, then is a disclosure of informations, uh, you know uh, no, sorry, direct tax avoidance scheme here that aims to reduce tax liability on direct taxes such as income tax or national insurance. So disclosure of information, uh, the obligation of taxpayer and promoters of tax avoidance scheme to disclose details of such schemes to HM or revenue. So tax irregularities. Instance of non-compliance with tax laws or regulations, including tax evasions, tax fraud, and other forms of tax non-compliance. Next is VAT avoidance scheme. Uh, have you got any idea about VAT avoidance scheme? Quickly, in short.
No.
Oh, okay, it's just a schemes that aims to reduce tax liabilities on value-added tax. So you work, most of times I think so for VAT.
Hmm.
So conflict of interest situations. This is situations where a tax professionals, personal interests or loyalties, conflict, and then money laundering. Uh, the process of what we call disguising the proceed of illegal activity or legitimate funds to avoid detection and prosecutions. Serial tax avoidance, uh, practice of repeatedly engaging in tax avoidance scheme, so often with the intention of evading tax. Tax planning it's a legal, legitimate process of arranging one's financial affairs to minimize tax liability within the confines of the law. So, GARR, which is Journal Anti Abuse Rules. I'm sure it's a Journal Anti Abuse Rules which seeks to, uh, for tax advantages arising from abusive tax arrangement that are contrary to policy intent of the tax law. So here is the same in he is explaining in detail. So we'll go to fundamental of ethical principle. So no, just you know, self-interest. You know, and an accountant, basically an accountant has five fundamental ethical principles. Self-interest, self-review, familiarity, intimidation, advocacy. So, basically, there are several potential threats to ethical behavior for accountants in practice and in business. So, these include self interest, such as having a financial interest in a client, relying heavily on a client fees or for income, or having a personal relationship with the client that could compromise objectivity. The self review is self review with occurs when an accountant is asked to evaluate or justify decisions they were involved in making, or discovering a significant error when reviewing their own work. So reporting on system that can accountant help design, or preparing data used in reports that they are required to check, can also uh, be a threat. So familiarity, the mitigate these threats. Familiarity uh, is having a close or personal relationship with a senior employees or a client. Then intimidation, dismissal, replacement, or litigation in respect of engagement. So pressure to reduce quality of work to keep fees down. So acting and behalf advocacy is a common term, behalf of an audit client which is an dispute with a third party. uh, Basically, to mitigate these threats, it is accountants to maintain their integrity, objectivity, professional competence, and to behave in a professional manners. So accountant should be aware of conflict of interest, such as having a close relationship with a client, or a financial interest in an employee. Uh, some that some accountant work with their clients as well. That might
Mhm.
be like a partners, or they share things with their businesses. So safeguards. So the five fundamental example of safeguards in the work environments. So the five safeguards here: a development of leadership culture that stresses importance of fundamental principles, then policies and procedures for quality control, then policies that identify threats, evaluate their significance, and identify safeguards. So they then procedures, they use risk management methodology, and different kind of safeguards. So procedure that prevent non-team members influencing and engagement, communication of policies and procedure of all to all staffs. uh, Here is a review uh, current issues in taxation. So your manager has received an email from Lemar. Lemar is an managing director and majority shareholder in REP Limited. Lemar and REP Limited are clients of your firm. So your manager has forwarded the email to you, together with an email deleting to work you are required to do. So email extract from Lemar, dated 7 September and 2020. So we are in discussion with the management CRO Limited regarding the establishment of a new company, J Limited, if it possible. J Limited will commence trading on 1st of April 2021 and carry on businesses activities in the country of Garia, where it will manufacture computer components. CRO is proposing REP Limited would own 30% of the ordinary share capital of J Limited, with CRO Limited owing the remaining 70%. However, we regard this potential investment as somewhat risky, so such that if we decide proceed, we may prefer to own 20%, just 20% of J Limited rather than 30%. So basically, in this email, Jay has tax adjusted trading profit for the year ending 31st March 2022 is budgeted to £135,000, all of which will relate to its activities in Garia. J Limited will have no other source of taxable income and will not make any chargeable gains during the year. So we have been involved in joint venture like this before, and we have no experience of carrying on a business outside the UK. We would appreciate your advice on following three extract from the documentations provided to use by CRO. It has not been determined whether J Limited will be resident in the UK or in Garia. So if J Limited is resident in UK, it will be considered to be carrying on a business thought permanent establishment in Garia. If J is resident in UK, we will consider making an election to attempt to overseas trading profit from UK tax. So we have been advised that if J Limited is resident in Garia, this will not result in charge under the controlled foreign company rules. So J is set to commence trading on 1st April 2021 will be engaged. So here purchase or investment property, which is REP. So uh, and will be engaged in business activities in the country of Garia, where it will manufacturing components. So CRO is proposing that RPL 30% of the ordinary share capital of J, with CRO LED owing the remaining 20%. So this email also mentioned the possibility of participating in the year ending 31st March 2020. So during which J is expected to have a trading profit of £135,000. The manager has no prior experience in joint venture. So uh, like this ventures like this, and no experience in conducting business activities in the UK. So where J will be considered to be carrying on its business through a permanent establishment. So this email also notes that investing in J's operations Garia will not result in a charge under the control foreign controlled company. So there are if I quickly that purchasing investment. So purchasing investment property, we are considering the purchase of by RP Limited of a new unused commercial building for £200,000 plus 20% value added tax. So REP Limited would then grant a 20-year lease of this building to a retailer. Will REP Limited to able to recover the VAT charged by the vendor on the sale of this building. So basically, there are two separate issues that need to be addressed in this scenario. Firstly, REP Limited is considering purchasing a new commercial building for 200,000 pound plus 20% VAT and granting a 20-year lease to a retailer. So the question is here whether REP Limited will be able to recover that VAT charged by the vendor on the sale of the building. So the second issue is the individual who established discretionary trust in 2010 is planning to give £20,000 of their shares in REP Limited to the trust on 1st November 2020. After the gift, they will still own £60,000, 60,000 shares, which is 60% of the company. So it has already been established that these shares do not qualify for business property relief. So there may be an inheritance IHT, inheritance tax liability. However, the individual has made, previous gift uh, uh, without incurring in, first no- in first November 2020 may result in inheritance tax liability. So if I decide to make a gift, so without, so here basically might be a previously gift without incurring an inheritance tax liability. So here purchase of investment property, we just uh, here is the question is talking about purchase of investment property, proposal gift or share loss trust on 1st November, shareholder value per shares. Then we just give a question and prepare the meeting notes. So everything is here in within the email. Investment in J, residential of J, which is not in the Garia, not a foreign country. So controlled foreign company rules, election to exempt the profit of J. So proposed gift of shares. These are requirements. So for further reading, you can visit www.ACCA or IFAC International Federation of Accountants. So that's it for today. Any questions so far, Nizar?
No, it's fine. Thank you.
Okay, so that's it. So if you have any question related to today's session or regarding assignment, just drop me an email. So I'll get back to you. So you got my number and email is tutor dash management at ukversity.co.uk. So that's it. So have a good day, Nizar. So if you have any question, just let me know
Yeah,
through my email or
perfect. Thank
number. Okay.
you. Okay, fantastic.
Thank you. Bye. Have a good day. Yes,